Welcome to the third episode of the Weekly Real Estate Roundup. Once again, I am Bill Clifford from Mindful Mortgage Solutions, here with my partner, Ray Gutierrez.
Howdy, everybody. Welcome back for week 3. A lot happening this week. I'm sure a lot of you have heard about the news. There's been a run on the banks, a good old-fashioned run on the banks. Silicon Valley Bank is no more. The FDIC has taken over. That means they're insuring deposits up to $250,000, and beyond that, it's all up in the air. What does that mean for the world of real estate? Let's talk about it. Bill, what happened with Silicon Valley Bank?
Well, Silicon Valley Bank decided in the summertime, from what I read, that they had an influx of deposits. So they had a bunch of money coming in, and when they get those deposits in, they reinvest them. That's how one of the ways banks make money. They take the money that you've given them to hold on to, and then they reinvest it. They give you some interest, generally not very much interest, but a little bit of interest on your savings accounts and stuff. But they reinvest that money, and they earn money on that. So they got all this big, huge influx of money, and they wanted to get it out there and get it invested, and they weren't able to get the yield they were looking for. So for whatever reason, they decided that a good idea would be to put $80 billion. Granted, this is the summertime of 2022, right? Things were already starting to slow down. $80 billion into federal mortgage-backed securities, which are pretty safe bets. It's Fannie Mae and Freddie Mac. I mean, they hold the majority of the mortgage notes in the country, but the average yield of those investments, meaning the average interest rate they were collecting, was 1.56%, right? So that's not very much money. I guess if your savings account has been getting 0.25% for the past couple of years, maybe they're thinking, well, 1.56 isn't bad. But if they took a look and listened to what the Federal Reserve was saying, talking about how they needed to raise rates because inflation was starting to creep up and all of these things, and I believe they'd even started raising rates already, they would understand that inflation is going up, and inflation is around 6% or something like that right now. So if you're getting 1.5% on your investment, but inflation is going up at 6%, that means that your money is not, you're not earning enough money to keep up with the inflation. So you're effectively losing money on that investment year after year after year. And what's worse is that those mortgage-backed securities investments were almost all for 10 plus years, meaning that the maturity date, it's like if you buy a CD that's, you have to hold for 2 years before you can cash it in. These were 10 plus year investments. So
they can't unload them.
What's that?
They can't unload them.
That's right. So, they sold some other stuff. They told everybody they needed to raise a couple $2 billion to kind of even things out, and it freaked out their investors. And another piece of that bank is that they are, almost all of their clients are venture capitalists and hedge funds, and but venture capitalists primarily. So they're financing startups, Silicon Valley startups. It says 50% of at least over 50% of all startups that are backed by venture capital had their money in this bank. So that could have a real big domino effect. I mean, if these small companies lose a lot of their deposited funds, then who knows how many of those are going to go down. And we also already are seeing the tech sector with a lot of layoffs. So this is bad news. I just cannot. It's just hard for me to imagine how anybody could have thought it would be a good idea to put $80 billion into 1.5% interest rate.
Right. I think there is, I know for me, and I bet a lot of people probably kind of have felt this way at some point in their life, right? But, when you think about the economy, right? You think about billions and billions of dollars and trillions of dollars, and these, huge organizations that manage all of this money for all of these people. There's and maybe it's a naive assumption because you want to believe that they know what they're doing or that they're competent, right?
Mhm.
Um, but at the end of the day, like these are just people and they make mistakes. And when some of these people make mistakes like this, it has massive, massive repercussions, right? So there's Silicon Valley Bank going down. There's, this isn't, or it's not proven to be quite yet, although there's been some reporting that the CEO cashed out for a certain amount of money a few weeks ago, right? Maybe seeing the writing on the wall, right?
Well, at Silicon
Uh,
Valley Bank.
yeah, yeah, yeah. So, but we haven't confirmed that this is a big scam or anything like something like FTX, where that was just a straight up Ponzi scheme.
Mhm.
Um, but there are regular human beings who are in charge of billions and billions of other people's money. And when they make mistakes, crazy things happen. So you mentioned mortgage-backed securities, right? And
Yeah,
mortgage-backed securities are at the root of the 2008 financial crisis. So I'd imagine that when people hear that there's a connection to a big bank failing that's involved with mortgage-backed securities, that perhaps they're thinking that there are some similarities to what happened in 2008 and what's happening now. Can you explain a little bit about what mortgage-backed securities are and whether you think there is potentially any type of correlation?
sure. So mortgage-backed securities are a bunch of a mortgage-backed security is a bunch of loans rolled into one package, right? So you go down to Wells Fargo and they offer you a mortgage at 5%, or we should say more like 6.75% if you show up today. Um, there's going to be a number of other people around the country who also have a 30-year fixed mortgage at 6.75%. So what Wells Fargo does is they take hundreds of those loans, package them into a bond or a mortgage-backed security, and then they sell that to an investor. So federally backed loans would be mortgages through that conventional mortgages, right? So any loan that falls under Fannie Mae or Freddie Mac. Fannie Mae and Freddie Mac make the underwriting rules for majority of the lending industry, and they also buy back the majority of the loans. So Wells Fargo writes that loan, they lend you that money, then they go and they sell the package back to Fannie Mae, Freddie Mac that re-injects them with capital so they can loan more money and continue operations. So they don't have all that money on their books. And
And
generally,
this is basically what drives the entire mortgage industry.
correct, yeah. The lending institutions don't just have trillions of dollars on hand to lend out. It's more these bigger organizations, right? And it's typically, Fannie Mae and Freddie Mac are publicly traded. There's also private mortgage-backed securities. So this is a big difference. And Fannie Mae and Freddie Mac had their problems during the financial crash as well. But what really drove it were the subprime mortgage-backed securities, where it'd be a package, a bunch of interest rates packaged together, and it would be people with 500 credit scores. But what they were doing back then is that they'd take a bunch of really ugly loans with that were very unlikely to be paid back. Then they'd roll in some other loans that were better, where people had higher credit scores and were more likely to be paid back. And I believe they would blend them and take an average, either that or they would just kind of show the good loans, and the mortgage ratings company or the ratings organizations, Moody's and Standard & Poor's, didn't look at it too deeply, and so they would give these investments an A+ grade, right? So you had a bunch of loans that were bound to fail in those mortgage-backed securities, which caused those mortgage-backed securities to fail, and it kind of blew up on itself. And I mean, in some cases, they would have one loan packaged into multiple mortgage-backed securities. And the whole thing was very sketch. This is not that. this is just a bad trade, basically. These guys simply bought these safe mortgage-backed securities from Fannie Mae and Freddie Mac at an interest rate that was very low. And, you know, and then what happened is, it's not like that trade would have even busted the bank. They would have lost some money, but I think they had, what, $250 billion on deposit or something, you know? So it's not like they're going to lose all of that $80 billion. They're going to lose a couple percent per year, which is a lot of money on $80 billion, but it's not the end of the world. But what happened is these hedge fund managers told their clients, you better pull your money out of that bank because they're having some problems. And, you know, the bank also didn't announce that they were expecting to have these problems. So everyone freaked out and started pulling their money out of the bank. And all of a sudden the bank didn't have enough money on, you know, on deposit to meet the federal guidelines, right? That they have to have, based on how much money they have out there invested in the world, they're required to have a certain amount on deposit. And yeah, everybody pulled their money out. They didn't have enough, and that's what got them flipped over to the FDIC for conservatorship.
Right. So in this particular case, like you said, the exposure to that bad trade wouldn't have been enough on its own to tank the bank. But the direction from the hedge fund managers to their people to start withdrawing their funds because they had lost confidence in the bank, because probably the bank didn't communicate clearly to those people that everything was okay. Like they started to find out probably through the news or whatever, right? They
Correct.
lose confidence, right? And they start to freak out and they say, pull your money out. And all of a sudden it creates this domino effect where a death spiral, where there's really, you know, nothing you can do. And the whole dynamic of a run on the bank is, well, once there's a tipping point and a certain amount of people start taking their money out, you don't want to be the last person in there with your money still in the bank, because you might not be able to get your money out. So everybody starts to rush towards the exits. And now the bank has been taken over by the FDIC, by the federal government.
Yeah.
The biggest failure since 2008.
Right. And another piece of this is that I think it's 56% of their deposits were tech startups or tech companies. So, and you know, tech companies that are backed by venture capital. So their customer base is this very specific kind of small community. You know, it'd kind of be like, let's say remember Paradise, California, that burned down a couple of years ago, the small town that burned down. Well, you have the Bank of Paradise, and everybody in Paradise has their money in the Bank of Paradise, and the town burns down. They're going to need their money so they can go live their lives, you know, and they pull all their money out. The Bank of Paradise is almost certainly going to fail, you know. It's right. But it's because it's like it's not diversified. You go, but if you look at Wells Fargo or a Chase or Bank of America or something, it's not like these large institutions are at risk of failing. This is granted, Silicon Valley Bank has Silicon Valley Bank is large in the fact that they have a lot of money on deposit. Yeah, all their money on deposit are from this very insulated community. So I don't personally think that this is technically that this should be a reason why the other banks start to have problems. But bank stocks across the board are down, and it's because of sentiment and confidence, which we talked about. And what happens is this entire market, our entire economy, is built on the sentiment of the people. You know, it doesn't really matter what the real story is. You know, Silicon Valley Bank made a bad investment, and you know, now they're going to lose $20 billion a year on that investment. Well, they still have $250 billion, and you know, have the opportunity to continue doing things. But instead, you know, people freak out. Everything's going down, run for the exits, the ship is sinking, and the ship sinks as a result. So it's hard to say. You know, there's I saw an article and they're like, are the banks going to crash? There's another one, another bank that had a run recently called Silvergate Bank. And I don't know a lot about that one, but that was a bank that was like all in on cryptocurrency. You know, we all know what happened to cryptocurrency recently with FTX, and you know, so these kind of seem like isolated incidences to me, but you never know what impact it's going to have on the market, because you don't know exactly what the news is going to say and how people are going to react to that.
People can panic,
Mhm.
and panicky people, like the economy, our society, all of that. It's just people.
Right. Right. No, I just read this great book. It's called Quants, and it's all about
Right.
the quantitative financial people, the people who created the algorithms that were driving the economy prior to the crash of 2008. And
Mhm.
you know, they said the chance of something like that happening was like if you flipped a coin 10,000 times and 9,999 times you got heads. That was like their odds based on their models and history and all whatever else. But the thing that they can't account for is this, right? Is for human behavior. And so I don't know. The whole thing is just it's just funny. You don't really know how people are going to react, and it's not even so much how people are going to react. It's about the spin that gets put on this thing, and the media has so much power, and it scares me. I mean, I think it really is the scariest facet of our life, because you know, in a time when media was meant to like, oh, you tell the news and tell the story and tell you what happens, and there's only 4 channels, and you know, you don't have to worry about it being too bombastic. It's one thing, but now it's like every story out there is like, oh my gosh, the sky is falling. You know, the sky falls every day in our day and age, one thing or another, and you know, so we'll see. It's hard to know.
Yeah, it's interesting in terms of the media, right? Like they can say, "Hey, don't worry, everything is fine," and everybody's gonna think, "Yeah, right. You know, it's not fine. I don't believe you."
Mhm.
Or they could say, "Actually, you should panic. Everything's crazy," and everybody's gonna go, "Ah!"
It's true.
um,
It's true.
so it's kind of like, you know, the fear that drives people is so strong because people are so much more motivated by um, avoiding pain,
Mhm.
right?
Mhm.
Than we are really anything else, right? If there's something out there we can see, like, oh my god, you know, I better go get my money out of the bank because I might not. Like, if everybody in the country right now decided to withdraw their money from the bank, right? Just go to the ATM, go to the bank, and just take out all your money, right? Which, you know, you're totally entitled to do, right? It's your money.
Mhm.
The entire financial system would collapse.
Right. Right.
That is a thing that we could all go do right now. And you know, as we're talking, I'm just sort of scrolling on Twitter, and there are reports of people, you know, at different banks around the country lining up to take their money out of the bank, right? And it's these things where, you know, I haven't gotten too deep into it, but people are raising questions about Wells Fargo because apparently there's like delays right now in Wells Fargo allowing people to get some of their money out. And you know, we don't believe that this will create a sort of widespread panic like the one I just described, but clearly the entire economy is interconnected, and you know, if one thing is happening over here in one sector, it affects things that happen in another sector, and people start to react. So with that said, let's talk about how mortgage rates are reacting to the economy today. What's going on with rates?
Well, the good news is that when the sky is falling, the interest rates go down.
Right.
Yeah. Unemployment. So we got a jobs report this week, and on the surface, it looked pretty good. It said, hey, there's 310,000 new jobs added, which would be a good number, and it was above expectations. But they also found that a higher number of people have entered the workforce. So more than $310,000. So there was actually a net loss. And one of the numbers that popped up was that the number of people that were out of work 5 weeks or less was 345,000. So that's a lot of new unemployed people. And this is not based on unemployment claims. This is the household survey, I believe, pulls this number. But the jobs numbers are so hard to really gauge. There's so many adjustments and so many things. So trying to get a feel for what's actually happening out there is I just don't think that those numbers are going to give you the best look at it. But because that happened, they're saying, oh, okay, well, now the unemployment rate has gone up a little bit. So maybe that is a sign that the economy is cooling off and we're starting to see some recession. Another thing that happened was that the average hours per week that people worked also went down a little bit. I believe it was by an hour a week. And that's also an indicator, right? If companies before companies start firing people,
Sure.
if they need to save some money,
their
they
hours.
just cut people's hours a little bit. Yeah. So these things are in the jobs report are indicating that the economy is likely starting to slow down. And then you have the Silicon Valley Bank and this other one, Silvergate. Those things also, the stock market reacted to that. And when the stock market comes down, that's another indication that the economy is slowing down. Inflation should start coming down, interest rates come down. So again, it's all kind of based on sentiment and confidence and speculation and all these things, but we've gone from about 7%, maybe slightly over 7% last week down to 6.75. So another good move in the right direction.
Right.
And I can actually, if you want to see how this looks on the chart, I'll show you what the 10-year Treasury bond looked like this week. Pulling up.
It's kind of like when the Fed describes looking for a soft landing for the economy.
Right. What they're hoping is that we don't see massive unemployment, but inflation still comes down. That's what the soft landing means. And that's a very, very tough task.
Right.
This particular Federal Reserve with Jerome Powell at the head, when inflation started going up, they were saying, oh, it's transitory, meaning that it's going to pass.
Right.
It's just a blip on the screen.
Right.
And then now it's going up, and now that it started going up, they're like, oh, shoot, we've got to do this. And they're throwing the house at it. They've raised the federal interest rate by 5%, faster than they've ever raised it. And now we have things like this happening, right? Unintended consequences. And that's the thing on those bonds that Silicon Valley Bank invested in. Now you can get 5% on those bonds that they're getting 1.5% on. So, it's that's a result directly of the Federal Reserve raising the rate, and there's probably some other things that are going to be affected by this, and these things lag a little bit too. It's not like everything happens in split second time. Things marinate a little bit. Let me show you the screen. Okay, so here we go. So this is the yield on the 10-year Treasury bond. You can see how this goes. Typically, when this is going down, interest rates are also going, or excuse me, this is the right chart. No, wrong chart. There we go. Yeah, when this one goes down, interest rates are going down. When this goes up, rates go up. It follows a similar pattern pretty closely. And so you can see down here, this is early February. Here, that's January. So this is when we got the February jobs report that came in a lot. Right? I guess the January jobs report came out from this date. This caused the rates to spike. Inflation didn't go up as much as expected. So rates up. And then here we go. This is Silicon Valley Bank starting to get their issues. Jerome Powell's been talking to Congress as well, and then the jobs report comes out, and this is what we see: massive drop today in this index. So, we're getting back to where we were in early to mid February. If this keeps running, then we could get back. Hopefully, we will get back down to levels where we were at when the rates were starting to approach 5.5%. So we shall see, but it's a good thing for interest rates when when there's a little turmoil in the economy, because it indicates that people are going to hold on to their money and they're not going to be out there spending. The more people spend, the more the inflation goes up. So
right. Yeah, those rates have fluctuated so much in just a short period of time.
Yeah.
Right.
Yeah.
Which tells us that the economy is kind of like all over the place right now.
Well, and it's been this up, down, up, down.
Yeah.
Usually it's a slow rise up or a slow move down, but it's just, typically right now it's been the inflation reports have really been the key thing, and the jobs reports, and they come out around early in the month to give numbers for the previous month, and they're moving things in a massive way. So, we do expect to see those inflation numbers continue to go up. So I think rates should continue coming down. We'll see. We could have some more bumps along the way. I think I heard that April might pop back up, and then May is when we expect to see them start coming down more continuously.
So, from the perspective of a person who is just in the real estate market right now, looking to buy a house soon, right? Does it make sense for them to, because everybody's always trying to time the market, right? And
Yeah.
it's really hard to do that. Like you just showed that graph where the rates are going up and they're going down and they're going up and they're going down, right? And the economy is clearly quite fickle, and it's being driven by all of these forces that are really big forces that, to the individual who is just trying to buy a house, right, they can't really deal with any of that, right? They're just trying to get into a position to be in the right place at the right time.
Yeah.
Does it make sense for a person like that, even if they're just trying to time it and maybe they think that rates will come down, let's say in 3 to 4 months? Does it make sense for them to start getting their pre-approval process done now, so that even if they're not ready to buy quite yet, they've already gotten some things done, they've gotten some of the process done, so that they'll be in a better position to capitalize when the rates do start going down, because the rates might go back up in a month or two. It's better to be prepared.
Yeah, it does make sense. And I would say the other thing that makes sense is to keep an eye on what's out there. The big fear that I have is that the rates are going to come down and we're just going to get a boom of buyers, and there's not going to be enough homes on the market to satisfy everybody. And there really is just not enough new construction happening. There's not enough people wanting to sell their homes. So I think we're going to see just not enough inventory on the market moving forward for a while. The only thing that's really going to change that is if there's a lot of job losses and people have to sell their house because they can't afford their payments anymore. And it does seem like we're getting to a point where, the unemployment rate is going to go up. There's going to be more people out of work. Is it going to be enough to really create a bunch of inventory in the market? That's hard to say. It certainly is not going to be 2008, where all of a sudden there was 10 times more inventory than there had ever been. But I don't know. We'll see. My thought is be prepared, get pre-approved, be ready to go. Keep your eye on the market. If you see something that you really like, go for it. Because again, if you can buy a place and get it at a good price, going to be good. I do not think that we're going to see prices dip much, if at all. They've come down in lots of parts of the country a little bit, but here in Los Angeles, they're holding pretty strong. From what I've seen, I may see them differently, but I know from what I'm seeing, especially for entry level kind of things, I think the more luxury market, $2.5 million plus that, you're seeing stuff come down there. But for the entry level, which is under $1 million, or probably under $1.2 million here in Los Angeles for a single family home, or maybe in the $800,000 range for a condo, those things are flying off the shelf still. They're still getting multiple offers. So, if you have an opportunity to buy something that you really like, make sure you're prepared. The other reason to get pre-approved ahead of time is that we can, if you have some credit issues, or maybe you are self-employed and need to file your taxes, we can give you some insight on maybe you shouldn't write off all of this stuff this year if you want to qualify to buy a house. So it definitely is helpful to be prepared, even if you don't think you're ready yet, if you want to wait it out. And I certainly understand why people would wait it out if even if they see something that they like, because the thought is maybe they will come down. That's not my advice, but I certainly sympathize with anybody who wants to go that route, and we'll see what happens. That could be the right way to go.
So, like, tax season, right? It's a good point. People are going to do their taxes, and that could have consequences on their ability to get pre-approved, right? And the way in which they file their taxes, right?
Yes, for self-employed people. Yeah.
So it would be a good idea if those people are also potentially thinking about buying a house to talk to a mortgage consultant now as they're preparing their taxes, and get a sense of what it is that they need to have ready to be able to do their taxes and get a pre-approval during the same window of time.
Well, that's right. I mean, and I'm going through this with a few people right now. And for some people, the advice is, why don't you file an extension and wait to file your taxes until you buy your house, right? Because maybe they did well in 2021, 2022, they're going to show less income than they had last year, or, they have a lot of write-offs, a lot of expenses in 22. So maybe hold off and don't file your taxes yet. For some folks, the advice is going to be, look, I know you could potentially write off $100,000 in expenses, but if you want to qualify for a home, you're going to need to, you can only write off $50,000. You're going to have a higher tax bill, but you'll be able to buy a house. You have to decide whether that makes sense for you or not. But at least it gives them the opportunity to make that decision without rather than just filing their taxes, writing off as much as they can, and then ending up not being able to
finding out later that that wasn't necessarily the way that they should have gone about it if their goal was to get pre-approved.
Correct.
This year. Yeah. And there's a lot of self-employed people in LA who
there certainly is.
Yeah. Actors, writers, entertainment people, whatever, who are in that type of situation. And it's always better to consider your options before making those decisions, just because you think it's the right time to, it's tax time, I'm just going to file my taxes and not think about it, and then a month later go, I really would love to get pre-approved for a mortgage, and just to find out that, well, because of the way that you file your taxes, now that's going to be a lot harder.
Right.
We're also not saying to not file your taxes. It's not what we are saying.
You are allowed to extend them without that is totally okay. So let's see here. What else did we want to talk about? That's kind of the long and short of it. What are you seeing in the market right now with your
what you said about luxury properties being the properties that are staying on the market a little bit longer, and more entry level stuff still being in high demand, especially here in LA. Like, that's absolutely true. it just makes simple sense, right? There's going to be fewer people out there who can afford those luxury properties, so there's not going to be as competitive a market for them. Whereas there are more people that are going to be able to afford more entry level homes, so there just aren't enough of them. The reality is, as much as we talk about interest rates going up and down, and the economy and all of these macro level things, none of these things really deal with the core problem of the housing market, which is inventory.
Mhm.
There needs to be more homes built. There needs to be more people who understand the basics of qualifying for a mortgage and get themselves in a position to do that. So until those things are addressed, hopefully there's somebody out there right now that's building some sort of application that is tackling these problems. Then we're going to be seeing these same supply and demand issues that are going to create a highly competitive market that makes it really challenging for people who aren't being advised by real estate professionals like ourselves to be successful. So our advice is get connected with real estate professionals, ask questions. If you're not ready to do business this month, this year, but maybe you're thinking next year, getting connected sooner is better, right? Getting
Right. Yeah.
connected
Figure out who
and
you want to
starting to
work with.
find out, starting to find out, what it is that you need to do ahead of time will put you in position to win later when you are ready to go. It's that hasn't changed as much as the economy has shifted in the last 2023 now. So we'll say like 4 years, right? Like pre-pandemic, during the pandemic, and now after the pandemic. Crazy stuff, right? The fundamentals of the real estate market have remained the same here in Los Angeles that entire time. It's supply and demand. There aren't enough houses out there, and unless everybody loses their job or we build a million new homes, that's not going to change anytime soon. So do the basic things. Get in touch with Bill. Get pre-approved for a mortgage. Ask questions. Start doing your research, and be ready, because timing the market, it's better to get in when you are able to, and then just start building your portfolio and be in a position to refinance later.
Right. One other bit on the unemployment. A key indicator of recession is once the unemployment rate hits its low and then starts going up. So this may have been the first month for that. This may have been the first month for that. I had one other point and I lost it. Until next time, I guess.
Until next time. Have a good weekend.
Oh, that's what I'm
everybody.
sorry. I came back. What I was going to say is, beyond getting in touch with me for a pre-approval, they should be contacting you to get on a drip campaign, so that as things are coming on the market that fit into somebody's general guidelines of what they're looking for, what neighborhoods and price points and those sort of things, just so they can see what's popping up, and keep their eye on it, because you never know, something might show up and it's like, wow, that looks great, that's the one I want. And maybe the opportunity will come where you can actually negotiate for that property, just like we did when I bought my house. For those who do not know, Ray, we got in at a time when the prices were going up, and this place had just fallen out of escrow, and we jumped on it, and Ray helped negotiate $90,000 off of the price, which is like unheard of. So he's definitely the guy to work with.
Yeah, and we can set people up on drip campaigns. So that's a thing where we just talk really quick about what it is that you're looking for, right? And then you just get some automated emails that send you new properties that fit those parameters, and you can take a look at them when you want to. You don't have to talk to me at all until you feel like you see something or you have a question, and then just shoot an email, pick up the phone, send a text, ask a question. and then we're ready to start talking and getting to work. So that's how this stuff works. Just get in touch and keep an eye on the market.
Definitely. All right, everybody, have a great weekend. Thank you for tuning in. Yeehaw.
Yeehaw. See you next time. Thanks, Bill.